Type a name, an address, a birthday, an email. The form looks ordinary. The account is not, because the system never checks whether any of it is true. Click Create. Now you can move a private digital currency called LR to another account, across borders behind a name that may belong to a real person, a stolen person, or nobody at all. And according to the 2013 case against the company, an extra 75 cents could hide the sender's Liberty Reserve account number from the transfer. 75 cents. By the end, Liberty Reserve held more than 5.5 million registered accounts. It had processed more than 78 million financial transactions, carrying more than $8 billion in combined transaction value. That $8 billion was money moving through the network. It was not Arthur Budofsky's wealth, and it was not all proved criminal. His guilty plea covered a different number, between $250 million and $550 million in criminal proceeds tied to U.S.-based users. Both figures are enormous. Neither explains the strangest part. A private money network had reached global scale while refusing to answer one of finance's oldest questions. Who are you? An investigator tested the system. Name, Joe Bogus. Address, completely made up, city, New York, United States. The account opened. The joke was fake. The account was real. Other users were even less subtle. Government records identified account names that openly referenced hacking, stolen cards, and criminal trade. Some read less like aliases than confessions typed into a username field. Yet the accounts remained available to move money. That was the design advantage. Identity checks create friction. Documents, compliance teams, records that can later connect an account to a person. Liberty Reserve reduced that friction to whatever somebody chose to type, but a digital balance is useless until real money can enter the system and leave it somewhere else. Liberty Reserve solved that problem by putting people in the middle. There was one problem with an account like Joe Bogus. A digital balance still had to touch real money. Liberty Reserve's answer was to refuse direct deposits and withdrawals. The customer sent ordinary currency to a third-party exchanger. The exchanger, not Liberty Reserve, received the money and transferred LR from its own account to the customer. When somebody wanted ordinary money back, another exchanger reversed the process. The exchangers were not just doors into the network. They were insulation. They stood between Liberty Reserve and conventional banking, between the account name and the incoming wire, between money entering in one country and leaving in another. Liberty Reserve listed pre-approved exchangers. Government records said some operated in places with limited money laundering oversight, and some were connected to people running Liberty Reserve itself. The company earned money as LR across that firewall. Prosecutors alleged a 1% transfer fee capped at $2.99. They also said an optional 75-cent privacy fee hid the sender's Liberty Reserve account number. A global privacy feature priced like loose change. This was not a detail at the edge of Liberty Reserve. It was the architecture of entry and exit. The Joe Bogus account leaves a question hanging. Was the missing check an oversight or the point? Arthur Budofsky's history turns that system flaw into a sequence of choices. With Vladimir Katz, he operated a New York digital currency exchange called Gold Age. In May 2006, both men were arrested. They later pleaded guilty to conspiracy to operate an unlicensed money transmitting business. By then, Liberty Reserve was already running. The government's sentencing submission says it became operational in late 2005. Liberty Reserve was incorporated in Costa Rica in 2006. Over the next 2 years, according to that filing, Budofsky and Katz moved the operation there in an attempt to place distance between themselves and American law enforcement. Eventually, Budofsky pushed Katz out. He became Liberty Reserve's sole beneficial owner and principal operator, with final authority over the company's decisions. The sentencing submission says Budofsky and Katz built weak anti-money laundering controls and allowed customers to move money anonymously, regardless of the volume or source of the funds. That does not establish that every account was criminal. It establishes that the network had discarded controls meant to distinguish ordinary commerce from criminal proceeds. The internet found that opening before regulators closed it. The opening had customers. Government records trace money from online Ponzi schemes, stolen payment card data, identity theft, and hacking through Liberty Reserve. The crimes differed. The useful feature did not. Money could enter through an exchanger, cross LR accounts behind unverified identity information, and leave through another exchanger. Then investigators began measuring what that architecture had become. At the May 2013 takedown, prosecutors alleged roughly 55 million transactions and more than $6 billion in suspected criminal proceeds. That was the charging era estimate. By sentencing in 2016, the broader lifetime record showed more than 78 million transactions carrying more than $8 billion in combined value across more than 5.5 million registered accounts. Accounts, not a verified count of active human users. Transaction value, not a finding that every dollar was criminal. Budovsky's plea defined the narrower criminal proceeds range, between $250 million and $550 million laundered for U.S.-based Liberty Reserve users. The government called it conservative. 3 scopes, 1 progression, the allegation at takedown, the lifetime network record at sentencing. The criminal proceeds, Budovsky admitted. By then, investigators were no longer dealing with a strange payment website in Costa Rica. They were dismantling financial infrastructure. The response arrived through different doors at once. Budovsky was arrested in Spain. Other defendants were arrested in Brooklyn, Spain, and Costa Rica. Authorities seized 5 domain names, including Liberty Reserve's own domain and domains tied to exchangers. 45 bank accounts were restrained or seized. A civil forfeiture action targeted 35 exchanger websites. The Justice Department said law enforcement action stretched across 17 countries. Not a movie countdown, not a magic switch. Arrests, court filings, domain seizures, bank restraints, exchanger actions, different jurisdictions closing different routes around the same network. Then the United States Treasury used a tool it had never used this way before. Section 311 of the USA Patriot Act allows Treasury to identify a foreign financial institution as a primary money laundering concern and impose special measures around its access to the American financial system. Treasury called the Liberty Reserve action its first use of Section 311 authorities against a virtual currency provider. The proposed measure targeted correspondent and payable through accounts involving foreign banks used to process Liberty Reserve transactions. Treasury said it would effectively cut Liberty Reserve off from the U.S. financial system. Not every bank on earth, not the entire SWIFT network. The U.S. financial system. Liberty Reserve had built power by placing distance between itself and regulated finance. Now regulated finance was making that distance permanent. On January 29, 2016, Arthur Budovsky pleaded guilty to conspiracy to commit money laundering. On May 6, Judge Denise Coates sentenced him to 20 years in prison and ordered him to pay a $500,000 fine. The court described Liberty Reserve as an extraordinarily successful, large-scale international money laundering operation. The sentence punished the man who controlled the network. The case exposed something larger than one operator. Before cryptocurrency became mainstream, Liberty Reserve demonstrated how quickly a centralized digital money system could scale when identity checks disappeared, third-party exchangers absorbed contact with ordinary banks, and privacy became a purchasable feature. The technology was not magic. The architecture was visible. A ledger controlled in one place, millions of registered accounts, exchangers at the doors, money entering in one form and leaving in another. The system's defining choice was not that it made money invisible. Investigators followed domains, accounts, companies, and transfers across 17 countries. Its defining choice was that the person behind an account could remain unverified while the value kept moving. That choice created the product criminals wanted. It also created the evidence that finally closed the doors.